In the previous section, we've been able to establish the lease term. How do you recognize this in your books of accounts? Because we are looking at accounting for leases. At initial measurement, how do you measure the liability in the statement of financial position? Lease liability is the financial obligation for the payments required by a lessee, discounted to present value at either the interest rate implicit in the lease or the company's incremental rate of borrowing. So take note of these two words, interest rate implicit in the lease and the company's incremental borrowing. Let me just make it simple here. Assuming that you have a lease agreement to pay 1 million naira annually at the end of each year for 5 years, which is your annual rental. How do you recognize that liability in your books of accounts? So if I say 1 million naira annually, that amounts to 5 million naira. Okay? But now I'm not going to recognize 5 million naira because of the time value of money. So 1 million naira today will not be 1 million naira tomorrow, and it will not be 1 million naira next year. So I need to get the present value of each of these annual payments. So how do I get the present value? I need to discount the cash flows to present value using either the lease interest rates or my own incremental rate of borrowing. But most of the time in practice, it is not always very easy to get the interest rate implicit. The interest rate implicit is the lessor's rate of borrowing. So in the case where this is not available, the standard allows you to use your own incremental rate of borrowing. That means your cost of borrowing. So if my cost of borrowing is, say, 20%, I will discount those cash flows annually by 20%, and the present value of all of the cash flows forms the initial lease liability. But there are some components that need to be taken into consideration in the determination of the initial lease liability. Let's look at those components. Number one, fixed payments. For instance, as I said earlier on, 1 million naira every year. That's a fixed payment. But there are times that apart from the fixed payments, there will be variable payments. Say, okay, 1 million naira monthly is a fixed, annually is a fixed payment. Then there may be some variation coming as a result of market conditions. For instance, maybe inflation or market rates for that particular asset, say 1 million naira in the first year, increasing by 2% annually or increasing by 10% annually to factor in inflation. That makes the rate to be a kind of variable because of the rates, changes in rates. The third thing you'll be looking at is residual value guarantee. You've leased a vehicle, and the owner of the vehicle is saying that at the end of the lease term, the value of this vehicle should not be less than 1 million. When you are returning the vehicle to me, I should be able to sell it at the rate of 1 million. So it's like a residual value guarantee. You are guaranteeing the owner of the asset that he will be able to sell that asset for at least a value of 1 million. That residual value guarantee also forms part of the lease liability at initial recognition. Also, the purchase option and termination penalty. So if there is an option to purchase the assets, say, okay, after 4 years, instead of you returning the assets or guaranteeing that you are going to, the asset value will be a particular amount, there's a purchase option that's at the end of the 4th year, you will purchase the asset for XYZ amount. That amount forms part of the initial liability. Okay? So also, I want you to take note of the variable payments. For instance, if you lease an asset and the variable payment is based on performance, let's say I lease a vehicle and the lease agreement is for maybe 2 years, but it is not certain how much my annual rental will be. It's based on performance. Maybe the day I use the vehicle, I'm going to pay. I use it for 4 hours, I'll pay for 4 hours. I use it for 5 hours, I'm going to pay for 5 hours, and all of that. Such arrangements will not constitute a lease. And because, of course, I will not have the right to control that particular asset in such an arrangement. So any variable payment that is based on performance is not part of a lease arrangement. So for the variable payment, most of the times it will lead to that, the one that is tied to market condition, most of the time it's going to lead to lease remeasurements. Termination penalty. So where there's a termination penalty, within the period where the lessee has the right to terminate, if there's a penalty associated with that termination, then that will be considered as part of the initial liability. So put all these payments together, the present value of all of these payments becomes the initial liability to be recognized. Initial measurement of leased assets. So for the leased assets, the first thing you want to do for a lease is to first of all calculate the liability, which is what we did in the previous slide. So after you've gotten the lease liability, the next thing you want to do is to calculate the assets. And you start from the liability. Lease liability plus payment made before commencement. So if, as I said earlier on, I have a 5-year lease and the lease amount is ₦1 million every year, that's 5 million naira. If I have made a payment of 2 million before the lease commencement date, it means that that 2 million naira has reduced my liability from 5 million naira to 3 million. So in the calculation of the lease liability, I wouldn't have calculated for 5 years. I would have discounted 3 million naira to present value. That would have formed the lease liability in the previous slide. So that 2 million that I paid before commencement, if I want to now calculate the lease assets, I will add that 2 million to the lease assets to make it to be 5 million naira. So that my assets becomes 5 million. That 2 million is like a prepayment. Remember, prepayment is like part of your assets. So if I add the 2 million to the lease liability, that gives me the lease assets. Secondly, direct costs. So for instance, let me use a rented apartment. If I want to lease an apartment, I will need to pay legal fee, agency fee, and all of these fees associated with arranging the lease contracts. So those direct costs will form part of the lease assets at initial recognition. Then for asset that has to do with dismantling, the cost of dismantling the assets will also be added to the initial measurement of the lease assets. So if you have not watched the lecture on property, plant, and equipment, please do, so that you understand more about dismantling costs. So initial recognition, what are the accounting entry? The accounting entry is that the moment you establish the right of use asset and the liability, you debit your assets. Asset is always debited when you want to increase the asset. You credit your liability. Liability is always credited when you want to increase the liability. Accounting entry for subsequent measurements. Subsequent measurement means after the initial recognition. I recognize the lease in my books today. At the end of the year, how do I treat the lease transaction? So we have established that the leasee will recognize both an asset and liability in the statement of financial position at initial recognition. The lease liability will decrease annually by the repayment of principal and will increase by interest expenses. So if the lease liability is 5 million, as I said earlier on, if there were no payments before commencement, that means every year it will be reducing by the present value, let's just say 1 million every year. So at the end of the 5th year, it will become 0. But that 5 million will be discounted to present value, don't forget. And the interest will be expensed through the profit or loss account, while the liability will be reducing at the end of every year. So you debit interest expenses the moment you are paying for the lease, and also you credit your bank. The lease liability also is debited. To reduce it, bank is credited. The assets will be expensed on a straight line basis. That's for the lease asset to be expensed on a straight line basis. So the depreciation will be charged on a straight line basis. The depreciation expense is calculated by dividing the right of use assets by the depreciation period, which will be either earlier of the lease term or the useful life of the assets. So if the lease asset is 5 million and the useful life of the asset is 10 years, but the lease term is 5 years, that means the depreciation will be charged for 5 years, which is earlier of the lease term and the asset's useful life. Okay, the accounting entry for that is you debit your depreciation expenses and you credit accumulated depreciation. So we'll be looking at all of these in detail, but this is just like giving you a foundation of how to calculate your right of use assets and how to recognize it in your books of accounts.